Ladies and gentlemen, welcome back to an all-new edition of What Did We Learn? My name is Downtown Josh Brown. I am here with my friends Nick Colas and Jessica Rabe, co-founders of DataTrek Research, the authors of DataTrek's morning briefing newsletter, which goes out daily to 1,500 institutional and retail clients. They're also two of the smartest people I know. Nick and Jessica also have their own YouTube channel, which you can find in a link in the description below. It's earnings season, guys. I see you're pretty fired up about it. I know I am too. According to FactSet, analysts were looking for just under 5% earnings growth for the S&P 500 in the second quarter. That estimate has just risen to 5.6% as of the end of last week, as more and more companies beat their expectations. If that number holds, it will be the slowest pace of profit growth since Q4 of 2023. 83% of S&P 500 companies that have reported so far have beaten their second quarter earnings per share estimates. That is above the 5-year average of 78%, but it's still early. The average earnings surprise of 7.9% is also lagging the 5-year norm of 9.1%. One of the things you're hearing a lot about so far is that earnings during this earnings season are not the problem, valuation is. And so we saw a Netflix report, we saw JP Morgan, Bank of America, blockbuster numbers, just great reports all around, but their stock prices faded rather than rallied. So I wanted to start by asking you guys, do you think this kind of sell the news mentality is going to remain the trend throughout the rest of earnings season? Or do you think maybe people are just making too much of the first couple of high profile reporters?
Yeah, it feels like it is certainly a little bit of a knee-jerk reaction off the first week. I think things will settle down and we'll have a little better earnings season because the numbers are really strong and the analysts took numbers down. But you raised the right point, and we brought our homework today and wanted to put up the first chart, which shows valuations on the S&P, because this speaks directly to your valuation point, and I think very powerfully so. What the table shows is a grid of S&P fair values, and it ranges on PE ratios on the columns and earnings power on the rows. And the PE ratios run from 14 to 26 times. 14 is trough confidence. Like that's what you get when things are really just horrible. Investors don't believe in the future. And then 24 times is super peak confidence, like the highest levels we've had in the last 10 years. And then 26 is just beyond the 1990s .com bubble. So you have a wide range of confidence levels. And then you got earnings levels, anywhere from the current estimates of 264 for the year, 300 for next, and then some small haircuts to those to give us a more realistic view, because analysts are always too high on their numbers, as we all know. And the takeaway from this chart is the only upside to the S&P from current levels is if you believe we hold 26 times earnings for this year, and or 24 to 26 times for next year. Otherwise, the S&P's best case at fair value, or worst case, quite overvalued. So the message here is, yeah, valuations are extremely high, and not just current valuations. What you have to believe in order to own stocks here is very aggressive expectations for extremely high investor confidence in the future.
Right. You have to bet. Not only will we do those, the current full year estimate is $264 in earnings per share. So to be super bullish at today's level, you have to believe not only will those numbers hit, but that the sentiment in the form of the PE ratio will also stick, or even have upside from here. And that's like a little bit of a tougher bet to make.
It is. And it just, look, math is not an edge. This is not to say that you have to be long or short based on this math, but I think you have to understand why the math exists and then understand what the inflection points up or down are from here. My basic take on what's going on with that table is markets have been slowly reevaluating the durability of the U.S. economy and deciding that it's far more resilient than any prior cycle, 1990s, 2000s, 2010s. And there's a lot of logic behind that, because if you look at the shocks we've had over the past just 3 years, the 22 rate shock, this 25 tariff shock, the economy rolled right through those. Unemployment didn't rise, jobless claims didn't rise, labor supply is still fairly tight, wages are okay, and the U.S. consumer is holding in okay. Businesses didn't go and just do layoffs in 22 or earlier this year. And the upshot is you've got a very durable U.S. economy. You've got an economy that, absent a very large shock, without a policy response, just continues to grow, fundamentally because of this labor shortage, but also because I think there's just a lot of confidence built into the system right now. That's why the valuations are so high. And unless you get a big disruption, they can continue to be high. It's just remarkable that they're higher than pretty much any point in the last 10 years and holding in very comfortably at those levels.
Before we go into the sectors, can we do 2026? Just, for give people kind of the full picture, because I guess one of the reasons why you could make the case that today's valuation of 22 times earnings on $264 makes sense is that nobody's worried about 2026 as much as they were, because we're already almost in August and people are now focused more on 26 versus 25.
Yeah.
So when you look at 2026, you guys are pegging the current estimate at $300 per share of S&P 500 earnings. And at the current multiple, 22%, I suppose that would give us $65.99 as an S&P price target for year-end 26, which would be only a 5% return from here. Is that where you have it?
Exactly.
Okay. All right. So I suppose there's room to say, well, people are really thinking about next year's estimate of $300, and they're saying 22 might still be a reasonable multiple. And maybe from that standpoint, the market still has some, mid-single digit percentage upside, and that's the justification for buying stocks today. There's room to say that. It doesn't leave a lot of margin for error. And then the upside,
it leaves no margin for error.
No margin for error. And then the upside case is either $300 per share proves too low, or a ratchet up to super peak confidence, a 24 multiple on that $300 number puts us at 7,200 on the S&P, which would be 15% upside from today. So that's kind of like, I don't know, it feels extreme. It feels like extreme sentiment. I know it's not super extreme, but it feels like it's headed in that direction.
Well, I'll toss one more thing out, and I think Jessica's also got a comment here, which we need to hear. What I would toss out is that, yes, the market's looking at 26 earnings, very fair, but my paradigm is they're looking at 27 and 28 and 29 and 30. And there's always a discount in valuations for recession. There just always is. It's been since I've started doing this business in the 1990s. The market always says there could be a recession next year, 25% odds, 20% odds, and you have a lower valuation. Now the market's saying, no, the chance of a recession in any given year is maybe 5%, maybe 7%. And that's different from the past. I'm not saying it's right, but it is definitely different. And that's why you get these higher valuations.
It's a re-rating.
It's a re-rating.
If we think the probability of recession is 15% in any given year, then a 22 multiple makes no sense. If we think it's only 5% that we could have a cyclical recession, and people could scoff at that number and come up with their own estimate, that's fine. But if that's what the market consensus is now, a cyclical recession would be so rare that maybe it's a 5% probability, then a 22 multiple makes more sense in that context and may possibly even higher, would be the way that I would think about it.
Yeah, fair.
Yeah, I think there's also a story here about how the U.S. stacks up against the rest of the world. So we visit clients and business contacts across Europe on a quarterly basis, and their comments are always the same. There's an almost universal belief that only U.S. equity markets offer superior returns over the long term, essentially forcing marginal capital into U.S. stock markets. And that's because they view the U.S. economy as by far the most dynamic economy in the world, but also, even more importantly, one that generates the most innovation. They just don't have as many tech or high quality growth companies to invest in their home countries that as we do, and that makes ours a scarce asset. So of course there are some success stories in Europe, but those disruptive tech companies often decamp to the US while they're still private, or when they do choose to go public, because obviously, there's more liquidity here. And they also lack the kind of vibrant startup scene the US has. And without that, European equity markets just won't have the same pipeline of innovative companies that has allowed the US to outperform over the last decade. Global capital markets know that. And so honestly, US multiples may not have an upper limit relative to history. So to just circle back to the top of my comments, what we've learned from wealth managers, which are effectively RIAs in Europe, is that there's a massive change in how money is getting managed across the continent. It started in the UK about a decade ago. It's much newer in places like Paris and Milan, where we recently were, where retail investors are now going to wealth managers who want to allocate their money to the U.S. instead of, for example, local banks investing their money in Italian sovereigns or utility companies. European wealth managers, they really see U.S. big tech companies as globally scalable with large competitive moats and much higher returns on equity than rest of world market leaders. So we think this has a 20-year tailwind to it. It's a small sample size, but we think that means it's likely an even much bigger story than we hear about the sea change and how in the sea change of allocating European retail money to U.S. stock markets in the coming years and decades.
So it's such a great point, and I want to back up what you said with some data, because the people you're talking to, they're not just making comments, they're actually voting with their euros. Yeah. We got a report from the Treasury last week talking about foreign investor flows to U.S. assets, both bonds and stocks. And it turns out in the 12 months ending at the end of May, it's about $1.7 trillion from foreign investors coming into the country, which is not a record, but it's an enormous number. But what makes it an even more stark number is $600 billion of that over the last 12 months ending May came directly into U.S. stocks. Most of that, when you talk about foreign money coming into the U.S., there's an assumption people say, well, it's central bank related, or they're buying treasury bills because it's some sort of like risk off or rate arbitrage. 600 billion coming into stocks is not coming in from foreign governments or from foreign central banks. That's coming in from private investors like the ones that you're talking to. And it runs completely counter to the narrative that we heard right after the trade war started this April, where foreigners were going to yank their assets out of the U.S. stocks and bonds. They did the opposite. They plowed money in at insane levels. I think in May alone, $150 billion worth of foreign capital came into the U.S. stock market 1 month. So it's a really great point. Let's talk about the sector breakdown here, guys, because I know you looked at that as well, just in terms of current multiples versus their longer-term averages.
Yeah, I mean, we mentioned this, I think, in the last episode, but what's really important to understand is that it's not just tech that has got a higher multiple. It's not just tech driving that, that grid that we talked about. Every sector except for healthcare and energy is seeing a much higher current multiple on forward earnings than the 10-year averages. Every single one, industrials, materials, not just tech, comm services, everything except for healthcare and energy, for understandable reasons, has got a higher multiple now than 10-year averages. So it's really a rising tide of confidence lifting all boats. And I think it sort of supports both what Jessica and I have talked about, less recession risk and just incrementally a lot more interest from offshore in owning U.S. assets.
So one of the things going on, Savita Subramanian said the other day at Bank of America, companies that have a compelling story to tell about how they're using AI are going to have the best post-earnings reactions. And these are not tech companies, all companies. And I think that partially explains this rise in multiples for non-technology stocks that's accompanying the rise that we're seeing for technology stocks. It feels to me as though everything for the S&P 500 is riding on the AI story remaining fully intact. I don't know where else the earnings upside would come from. If you had to replace the AI theme in people's earnings expectations with something else, I don't think it exists. I don't know what MAGA. Like I don't even know what story if the story is so big, the AI revolution. Not just big in our imaginations, but in the way analysts are thinking about earnings growth. I don't know where else it would come from. And I wanted to ask you guys, can you remember a time where so much of the S&P 500's growth story was riding on a single theme, albeit it's a big theme? But this feels pretty unique to me, at least.
I guess I'm the oldest guy in the room, so I'll answer the question. And it's a great segue into Jessica's next module, and that is it's the late 1990s. It is the initial adoption of the internet. and for very
Okay.
similar reasons. Brand new.
How did that
technology.
end? For people that don't remember,
I'm not going to
Don't worry,
say
we'll get there.
we're
the
gonna
.com
get there.
capex story. How did that go?
Well, there were there. Okay, so yes, that's a very important point. However, how did it go for managers who didn't invest in tech in 95, 6, 7, 8,
Terribly.
9? Exactly.
Terribly.
So
Yeah.
yes, it ended badly, but it only ended once.
Okay. Let me give you
Yeah,
some
don't worry,
numbers.
I'll get to that. Yeah.
Yeah, I know we're gonna take that in a second. The 2025 estimate of $264 for S&P 500 earnings. You guys might have a different calculation on this, but IT and communication services combination contribution to that 264 is $79. Apple, the Mag 5. So I'm just saying Apple, Microsoft, Nvidia, Alphabet, Amazon. The contribution is about $30, which is actually lower than I would have expected, but there it is. But then when you add back the IT and communication services sectors are about 30% of total S&P 500 earnings. So not just those Mag 5, but then you're adding in like the IBMs and the Oracles and some. Okay. Those 5 companies, though, are about 38% of the earnings from all of the IT and comm services sectors. So they're really important within their sectors. And they will contribute approximately 11 to 12% of just those 5 names. So you guys might quibble with like the calculations or whatever, but like just directionally, if we agree that's, so then you say to yourself, well, in a world where that piece of the S&P 500's earnings don't come in to the extent that they're supposed to, that's a material change to the outlook. There's no reason based on these companies' comments that it won't come in. None of them are downgrading expectations. None of them are cutting capex. None of them are lowering their outlooks. But like everything is riding on that. And even the S&P 493, a lot of these companies, when they come out and report, the commentary is going to be all about AI, how we're using AI to do blank.
Estimates have come down enough that they should easily beat. Yeah, if they don't beat, we're in trouble.
Okay. All right. So, Jess, let's talk about the NASDAQ composite and that mid-90s bull run that Nick alluded to.
Sure. Okay. So we have a bit of a spooky chart. Since its low back in December 2022, the NASDAQ comp is eerily tracking its mid to late 1990s bull run, with the fundamental parallel being the internet then and Gen AI now. So this chart up on the screen shows an index comparison of how the NASDAQ comp performed in the 1,000 trading days following the start of 1995, marked by the blue line, versus its low on December 28th, 2022, through today's close, marked by the orange line. And whenever we publish updates on this chart, we get a lot of client comments, and it's easy to see why. History seems to be repeating itself almost exactly. So I have two points to put some context.
Wait, can we pause here?
Oh,
can we
yeah,
pause here? This is too perfect.
Yeah.
You didn't do anything with the scale or the lines of the chart. This is literally what it is.
Yep.
Oh my God. All right. I'm nervous. Keep going.
So first we start our comparison in 1995 because that year had a similar macro backdrop and bullish catalysts as the NASDAQ's latest rally. So like 2022, there was a Fed rate shock in 1994 after a period of low rates. And there was also a lot of enthusiasm about a new disruptive technology with the internet, which started to hit critical mass in the mid-90s. So for example, a lot of you will probably remember, not me, but a lot of you will probably remember Netscape went public in August 1995. And as for today, ChatGPT launched at the end of November 2022, which was a month before the start of the current tech rally, which has largely been driven by enthusiasm for Gen AI. And then the second point here is, if you want to just throw back the chart back up, the NASDAQ's following its mid-1990s experience, like you said, Josh, to a truly amazing degree.
Yeah.
So Friday marked the 639th trading day from the NASDAQ's low in December 2022, and it's up 104% since then. On the same day in the 1990s tech stock rally, which was in early July 1997, the index was up 100% from the start of 1995. So super close. But the important point here is that, as you can see in the chart, the path higher during both timeframes isn't linear. In the back half of the 90s, there was everything from valuation concerns after Alan Greenspan's irrational exuberance comment to Fed rate uncertainty given worries about the reemergence of inflation. And then you had some exogenous shocks as well, like the Asian financial crisis and the blowup of hedge fund LTCM. But the NASDAQ was able to power through it all until March 2000. So our big takeaway from this chart is that the mid to late 1990s experience shows bull markets do occasionally face pullbacks from growth scares, policy uncertainty, and valuation concerns, all of which are happening now as well. But large cap tech stocks recovered from resolutions to these issues pretty quickly and went on to rally for years, again until March 2000, as companies capitalized on the internet going mainstream. So like any new technology, its success relied on a virtuous circle of adoption and killer apps. And the same will be true for Gen AI now. And as you alluded to before, yes, this example eventually turned into a bubble that then popped. But we do think that this comparison shows U.S. large cap tech stocks are still early in a secular bull run driven by monetization opportunities around Gen AI, just like the internet in the 1990s. And that's why...
Jessica, how far away are we from that hypothetical March 2000? Like, how many months away would that be? Of course,
still pretty far. So right now we're about in July.
Is it a year?
We're in July 1997. Like we're like a few years away.
So we have like years.
We have a long time. Yeah.
If that paradigm, I mean, of course, like none of us think it's really going to match perfectly with the end of this thing.
Yeah.
If it even is an end. Okay.
Yeah, we're not saying that the past is prologue, but this is one reason, though, why we viewed the last few months of volatility as buying opportunities. So, for example, we published a report to our clients back on April 10th that said the NASDAQ 100 and U.S. large cap tech sector should rally since both hit 3 standard deviations to the downside over the prior 50 days, and they're up 26 and 34% since then. And our 1990s experience, or 1990s comparison, shows they should continue to rally from here. I do have one caveat though, and that's we still do need to cross the chasm in tech speak and see wider adoption of Gen AI across more applications and chatbots like ChatGPT. That's why the market is rewarding so few names with Gen AI premiums, because it's still unclear how this technology will develop and see mainstream adoption. This isn't an argument for a bubble forming and bursting as much as returns just not getting as crazy as the late 1990s, but still chugging along at a decent clip. So actually last week we wrote a note that said, that was kind of bold, but the Magnificent Seven is dead, with investors now picking winners and losers between U.S. big tech names. Those that best leverage Gen AI are outperforming this year: NVIDIA, Meta, Microsoft, Broadcom.
Yeah, there's big dispersion in that theme. Absolutely.
Yeah, then you have laggards in the structural growth theme that are underperforming, like Apple, Google, and Amazon and Tesla. So we think the Mag 7 is now the Fab 4.
I love that, and I want to throw 2 things at you guys and get you to react. The first thing I would say is what's so crazy about that comparison. So people think of it as the .com boom, but they forget it was half .com, half wireless. That's when we all got our first cell phones. Before that, it was car phones, and Nokia was a leading global stock. Like people think of that as being, 7 years before the iPhone, or 10 years before the iPhone, that 95 to 2000 run. But very much there was a telecom story that was powering. It wasn't just internet. Robotics are not even in. Like nobody is yet, in my opinion. We don't have like a robotics giant other than Tesla. Like we don't have that wave yet, but that's where the AI thing is going to morph into, physical AI. And that a lot of people that I follow, a lot of technology people, not Wall Street people, are thinking about the second half of the 2020s as beyond AI, moving into robotics. And that's the kind of thing that could propel you for another 3 years before we hit that March 2000 analog top.
Yeah, I think that's a fantastic point. I think the biggest difference between now and the late 1990s, and the biggest difference between those two charts we just drew up was that there's been 15 turns in Moore's law between then and now. So computing power is roughly 33,000, not 33, 33,000 times more than the original computing bubble. So that incremental compute is driving incremental complexity and expense. That's existential difference between now and then. And right now there is a large scarcity, which you just alluded to as well. There's a large scarcity effect of Gen AI names, unlike the 1990s, that could continue for a long time. Because back in the 1990s, for example, it only took 6 months and a few $1 million for Netscape to build the Navigator browser. Gen AI takes years and billions of dollars to build, so the barriers to entry are dramatically higher now than the 90s. So the scarcity effect could last for years and propel public company valuations to extremely high levels, even more than the 90s. Right now, the orders of magnitude are just so much more complex.
One other thing I wanted to mention during this segment, guys, is investors are not confining themselves to the Mag 7 or the cloud computing platforms. And when I look at, I took a look at the NASDAQ 100, and I wanted to look at the biggest winners this year with the highest price to sales, because it's so widespread, this bull market. So Palantir obviously would be the first name to come to people's minds. It's up 400% over the last year. It's 122 times trailing price to sales. I don't know what the forward is. I assume it's less egregious, but I don't know. Maybe it's 60. Cloudflare, up 25% a year. Price to sales, 38 times. CrowdStrike, which, full disclosure, I'm long, 28 times sales, 40% year over year. Zscaler is also 40%, 15 times sales. Trade Desk, 15 times sales. Snowflake, 18.8 times sales. Huge winner, up 40% over the last year. Datadog, 18 times sales. ServiceNow, 17.5. Workday, 17. MongoDB, 16 times. So we've got layers and layers of big tech winners that have had a monster return and are now selling at teens price to sales and higher. And it's not that there's anything wrong with those stock companies or wrong with those stocks, but I'm just making the point that, like, the bull market has greatly expanded away from the Mag 7 at this point, and people are just going wild for all different stocks in all different parts of the AI ecosystem.
Yeah, it's true. And it speaks back to Jessica's comp, and it speaks back to our valuation discussion, because exactly the same thing happened in the 90s. I mean, I lived through it. 94 was a terrible year, big rate shock. And it gave investors a reason to start looking for things other than cyclical stocks. They wanted to start buying growth, because the economy didn't go into recession in 94, even though we had a rate shock just like in 22. And so they cycled into and said, okay, where's the growth? And the growth was, as you said, in two areas, the internet and then mobile phones. Radio Shack was one of the biggest stocks of the 1990s because they were selling all the mobile phones.
Right.
Also not just differentiating in the U.S., but also across the world, like going to Chinese tech stocks that are leveraging Gen AI as well.
It's funny. I forgot to mention this when you were talking about people allocating away from Europe, in Europe, and buying U.S. stocks. Yeah. They have a chip giant, ASML, and they actually disappointed last week.
Yeah.
It went down 14%.
Like ASML and SAP. That's it. Yeah.
Right. So their one chip giant actually ended up disappointing, and that would further reinforce Italian investors, Dutch investors, just saying, you know what? I like my tech stocks American. Thank you very much. Yeah.
Our line from talking to European investors, they love their culture, hate their markets.
Yeah. All right. Yeah. We're going to do NVIDIA and Tesla. Nick, I know you wanted to draw that distinction and how you think about valuation for these companies. Let's go there now to wrap up.
Sure. We got a table here. And it's a paradigm that I've used for, 20, 30 years. Think about stock valuations. And unlike using P/E ratios, I think it's a lot more illustrative of what's actually going on in a given stock. So the way I think about a stock's value is present value and future value. The present value of the stock is just how much it's worth if it can earn whatever it's going to earn this year or next year forever. So a perpetuity value. And the right-hand part of this table shows that. So it shows the forward-year earnings estimate for all the big tech names, for the S&P, and for some non-tech names, and then divides that by 0.1, 10%, and gets you the value of the stock if it were just to do nothing more than earn what it's earning this year forever. Now, the stock trades for more than that. So the difference between the current stock price and the current value is the implied future value, how much the market is implying, what percentage of the value of the stock is based on stuff that is to come, incremental earnings power, new products, new markets, all the good stuff. And what I've done is just rank the big tech names from highest to lowest, current price percentage from future value. So how much of the stock price is based on stuff that is to come versus the current earnings power of the company. And it ranges from 91% for Tesla. So over 90% of Tesla's value is based on stuff that's going to happen beyond its current earnings power, all the way down to Alphabet at 45%, which is simply that less than half of Alphabet's value is being driven by what might come from the future. And the average for big tech is 67%. So the takeaway from this is that Tesla's is very, very richly valued. 90+% of its value comes from stuff that is not evident in the current earnings stream. NVIDIA is roughly average, 67%, right alongside Amazon at 68 and Apple at 63. So yeah, more than 50%, but not egregiously so. The S&P trades for 52% future value, and then the largest non-tech names in the S&P, Berkshire, JP Morgan, et cetera, trade for 53%. So this gives you a range of expectations or a range of how the market is valuing the present for the market. So roughly half of the S&P is future value. Big tech, roughly 2/3 is future value. And non-big tech, roughly half future value.
So this actually makes sense when I look at the rankings here and I think about like the future value that investors are assigning to things that are not even in these companies' current earning streams. Tesla would be the stock I would expect to be there. Like maybe it doesn't deserve to be 91% above, but like that like sort of makes sense to me. And then amongst the tech giants, Alphabet being the lowest also makes sense. Because yes, Alphabet has other bets and they've got, they've got like quantum computing and things like that. But like for the most part, it's an advertising business. It's the Yellow Pages. So I actually sort of understand how investors have sorted these out, even if they didn't mean to, or how they've ranked these based on what they're willing to pay for that implied future value. Is that what you would have guessed as well if you had seen this list cold?
Yes, and we've done this math for years, so we kind of more track the development of these percentages. Yeah. Tesla is the one that is always at 90+%. Right. And it's just another reminder to people to say, the market already knows that this is all on the come. That's is literally in the stock. You can't short the stock or buy the stock based on those principles.
So the only way the percentage of the current price from future value, that 91%, the only way that's justified is autonomous and robots.
Yes.
For Tesla. We don't have to go into all the other ones. Of course, they're all going to be involved in autonomous stuff in some way and robotics, but like if you're a buyer of Tesla, you're buying it because you're bullish on Optimus, you're bullish on cybertaxi, and I think that's the robotics piece of that story. Depending on who you talk to, it's either half the story or it's the whole story. Nobody would say, "Oh, I'm in this for the cars."
Yeah,
I'm in it, right.
And the math says it's 91% of the story.
Okay, totally got it. I would just point out on robotics, you're not entirely crazy to ascribe that much value to Tesla as a result. And I just wanted to mention Mark Andreessen was talking about general purpose robotics recently, and he thinks it's tens of billions within the next decade. But he's also said things like Robotics is potentially the biggest industry in the history of the planet. It's his direct quote. He thinks it could be $26 trillion in global revenue divided between household and manufacturing applications. I think that comes from him, or it comes from somebody writing about his comments. But like, if that even is anywhere close to being true, then if you're an investor today, you have to be invested in companies that are going to play a decent sized role in that. And I think, like most people, if you just regular people, not professionals, if you just said like, which company is the best way to bet on robots, most people, they've seen Kim Kardashian posing with the Optimus robot in photographs, and they say, oh, it's Tesla. And it may end up being that way. It may not. Who knows? We'll all find out together. But that explains the bet that people are willing to make there, whether it'll pay off or not. You'd agree with that?
Yes, but it also explains why you have to be long U.S. large caps versus rest of world, because Tesla may not end up being the company. The company that may do it may be private right now, but you can be assured that they will end up going public in the U.S. when they're ready to go public. And so what's funny about index investing is you're buying the companies today, like literally you're buying the 500 companies today. But if you're going to hold for 10 years, you're also buying for all the IPOs over the next 10 years and all the disruption and all the growth that's going to happen over the next 10 years. So the stack that we see right now on this chart will be totally different in 10 years. And all we can be relatively assured of is whatever the winner is in robotics will be on this list.
Right. It's a pretty safe bet it's going to land there if it's a consequential company. All right.
Yep.
Guys, this has been amazing. It's so great catching up with you. I hope you're both enjoying your summer. I want everyone watching and listening to know that if you want to hear more from Nick and Jessica, and of course you do, make sure you check out their YouTube channel. There's a link to that in the show notes, or you can go to youtube.com/@the Nick Colas and Jessica Rabe. And you guys are on a regular basis putting out great stuff at DataTrekResearch.com for your clients. If you want to learn more about how you can subscribe to Nick and Jessica's work, please visit DataTrekResearch.com. Thank you guys. Great to see you. And we'll talk to you soon.
Thanks so much.